This is Macro Horizons, episode 382, Whatflation, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of July 13th. With CPI once again in focus and Warsh's emphasis on the trimmed mean measures, we'll observe that, apparently, inflation is in the eye of the beholder. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market had a relatively bearish performance, due in large part to renewed hostilities in the Middle East. Apparently, the ceasefire is effectively over. At least that's the messaging from the White House, and there have been reports of attacks between Iran and the U.S. For all intents and purposes, the Strait of Hormuz is once again closed to shipping traffic. One of the interesting aspects of the subsequent price action is that oil prices have been relatively well contained. In fact, while oil did increase on the headlines for obvious reasons, the front-month WTI contract managed to settle below $75 per barrel. Keeping in mind, at the beginning of the conflict, the same benchmark soared above $119 a barrel. So, said differently, the energy sector has offered a muted response to the apparent end of the ceasefire. To some extent, that follows intuitively, given the fact that the operating assumption of most investors is that, well, there might be hurdles on the way to a durable peace agreement between the U.S. and Iran, that eventually one will be achieved, and eventually the Strait of Hormuz will be fully reopened to shipping traffic. Of course, that might come with a few caveats, but as an operating assumption, the market appears content with the notion that this is simply a temporary hurdle on the way to a deal. The week just past also contained the FOMC minutes from the June meeting. The first observation we'll make is that, while technically shorter than the minutes of the last two meetings, the minutes from the June meeting were comparable in length to what we've seen in the past. What this implies is that a Warsh Fed is comfortable using the minutes to communicate in a similar fashion to a Powell Fed. Now, that certainly wasn't the story with the FOMC statement itself. Recall that it was effectively cut in half. So investors were able to take some solace from the fact that information flow will continue to come out of the Fed, at least in this traditional channel. The overall takeaway from the minutes was certainly less hawkish than the market's reaction to Warsh's first press conference as Fed chair, but by no means did the minutes take the potential for a rate hike off the table. Instead, the conversation among monetary policymakers appears to simply have been wait and see for the time being. If inflation does eventually start to make progress towards the inflation objective, then a rate cut could be appropriate. On the flip side, if some of the inflationary concerns eventually come to fruition, whether it's AI-related inflation, tariff-related inflation, or pass-through from higher energy prices to core inflation, then the Fed would be justified in starting a conversation about rate hikes. Overall, the takeaway was one of balance. Neither rate hikes or rate cuts appear to be high probability events, leaving us to assume that a stable policy rate is the path of least resistance into year end. The one clear caveat that the Fed offered is that the conversation about the forward path of policy rates that occurred at the FOMC meeting assumed that we would continue to have stable labor market conditions. We maintain that that's the big wild card for this point in the cycle. As long as the unemployment rate is low and we continue to have reasonable payrolls growth, the Fed will have the flexibility to respond to the shifts in the inflation outlook. In the event that there's a spike in the unemployment rate or a series of negative payroll prints, that will clearly change the Fed's calculus and will clearly limit the Fed's ability to hike in response to sticky pockets of inflation should they materialize.
We've got June's payrolls report, the long weekend is behind us, and the week ahead as true July trading conditions begin to set in, and the market starts to feel increasingly summer, will be defined by the inflation report and June CPI data that will show, at least in the early phases, how the broader inflation complex started to shift in response to the retracement in crude oil that resulted from the Memorandum of Understanding between the US and Iran and finally got ships moving through the Strait of Hormuz. Now, the realities of the calendar and when CPI is actually collected means that it's not going to be a pure look at how $70 oil flowed through to core inflation, but it will help set the stage for the July FOMC meeting and, more broadly, the departure point for how consumer price growth broadened out in response to the oil shock, or didn't, as Warsh took the helm at the Fed. Now, an idea that we've been discussing is that underlying the more supply-driven aspects of higher-than-expected inflation prints is a more concerning demand picture given the resilience of the growth outlook, which begs the question for the FOMC and for the bond market, what happens if oil is back at $70 a barrel and we don't see a more material moderation of the trajectory of inflation over the medium term? Now, there won't be a final conclusion on that uncertainty via Tuesday's numbers, but it is something to keep in mind as we continue to evaluate the performance of the real economy now that the distortions driven by the war in the Persian Gulf continue to fade.
And the data will also offer important context as the market considers what to anticipate from the Fed over the balance of 2026. Warsh has made it very clear that he is committed to fighting inflation, and to some extent that is simply a reiteration of the Fed's mandate and his efforts to ensure investors that he will not approach his role as Fed chair from a needlessly dovish perspective. We maintain that he will seek to have flexibility. He's already focused on reducing the amount of forward guidance and centralizing communication to a large extent. And it will be interesting to see how successful he is at controlling the committee's message. Clearly, there are other Fed speakers who will have opinions and comments on the market, on the real economy, and monetary policy as a whole. But over the course of the next several weeks and in the run-up to the FOMC meeting itself, we'll be closely following the tone of individual Fed speakers to see if there has been a degree of buy-in to this narrative of consolidation. Keep in mind that Warsh's agenda and the 5 task forces also have other line items of relevance, a major one being the size of the Fed's balance sheet. Any attempts to change the size of the Fed's balance sheet will need to occur over time and are unlikely to be immediate. This is made all the more so by the fact that Warsh has acknowledged that the findings of the task forces won't be available for 9 to 12 months. So if there was an argument to be made that we should be expecting some major near-term changes in the Fed's operating procedure, the realities of the timelines of the task forces push back against that notion. So we're left as a market to contemplate whether or not the Fed's reaction function truly has changed as a result of Warsh's position as Fed chair. The combination of core CPI on Tuesday, core PPI on Wednesday, and import prices on Friday will afford the market a fuller understanding of the performance of core PCE during the month of June. Recall, core PCE remains the Fed's favored inflation measure, at least for the time being, and will contribute to the case for the timing of the Fed's next move, if there is one on the horizon for 2026.
And it's not just Fed communication or how CPI, PPI, and core PCE are performing that's worth keeping in mind as we make it further into Warsh's tenure on the Fed. Ian, you mentioned the task forces and the different areas of focus that are going to be reviewed by industry experts over the coming months and quarters, and one of those topics is going to be the data that the Fed relies on to set monetary policy. Before he officially took over as chair, Warsh was quite vocal in his preference for using alternative measures of inflation. Trimmed mean PCE comes to mind as an example, And more broadly, what this introduces over the medium term is the potential for a broadening of perspective of how the FOMC actually views and measures inflation. So it's not unrealistic to envision a scenario where we make it into mid-2027, and after several rounds of academic review and discussion on the committee, we see a shift away from a pure focus on a 2% core PCE target into something a bit more broad-based that takes an aggregate view of several inflation measures. Remember, many regional Fed banks have their own measures of inflation. There's obviously some of the higher frequency inflation measures that are often cited as a better read of actual consumer price changes than the BLS's official numbers. And given the focus on reform at the Fed, in terms of communication, forward guidance, and monetary policymakers' relationship to data, we're going to be mindful of how the interpretation of the success in achieving the dual mandate might be more a function of different data points than we've historically been used to over the past several years. And so, as with so many aspects of the new Fed, this should keep the moves in treasuries far more a function of the actual realized data itself as it is released, as opposed to Fed rhetoric attempting to offer forward guidance. And particularly in a world where there's a broader set of data that could be informing the inflation mandate, that just means an elevation of importance of what used to be second-tier data to become far more market-moving.
And it is interesting when we put this in the context of the fact that the Fed has willingly given up one of its tools that it has previously used to move market expectations, i.e., forward guidance and the ability to effectively jawbone the market in either direction. The absence of a coordinated message among monetary policymakers that in the past might have led the market to price in or price out a rate cut really does add to the uncertainty. Whereas Powell might have been able to tighten financial conditions with a few well-placed comments or ease them, as the case may be, under Warsh's leadership, that tool has been set aside, at least for the time being. To be fair, Warsh has commented that while forward guidance might not currently be appropriate, at some point in the future, it might once again become a relevant tool. So perhaps we're simply at a point in the policy cycle where communication is trending lower, and eventually we'll get back to an environment in which there are more talking Feds, as it were.
And that's a function of the realities of the post-pandemic economy. Obviously, COVID changed a lot of structural things in terms of how the economy performs, people's relationship with in-office work, how frontline service sector firms are staffed, the role of automation, and a host of other dynamics that have lasted long after the quote-unquote return to normal and reopening of the economy in the wake of the pandemic. That's one aspect of a new economy that monetary policymakers need to acknowledge, and the other is, of course, AI, which is increasingly seen as a material structural shift in terms of labor productivity and what the workforce of the next several years will ultimately look like. It's not just from an economic perspective and the output of an individual worker, but it also is important given the capex boom that has defined much of 2026, what that means for equity valuations, what that means for actual economic activity in terms of hiring needs, in terms of data centers, in terms of debt burden. All of these factors combine to make an outlook that's been nearly as uncertain as it's ever been. The combination of game-changing technologies, a shift in the composition of the labor force, and demographic issues as well, all lend itself to it probably being more prudent for the Fed to say, we're honestly not sure. And so in this environment, it's not unrealistic that forward guidance probably isn't all that appropriate. But as time passes and these factors become more fully understood, as there's a growing body of data to evaluate the trends in this new economy, we could return to a place over the next several years where the magic 8-ball of monetary policy shifts from reply hazy to something a bit more concrete.
And in level-setting expectations for the upcoming Fed meeting, Warsh will be speaking on Tuesday following the inflation numbers. So that'll be an interesting setup if there is any of this presumably now elusive forward guidance to be offered. On the topic of AI, the market has generally settled into the notion that over the medium term, it might be disinflationary via lower wages, less labor demand, and a general increase in productivity. But in the very near term, it is widely seen as creating pockets of higher realized inflation, particularly as it relates to memory chips. We'll be watching on Tuesday for any pass-through to consumer electronics and how that does or doesn't impact the overall core series of inflation. needless to say, this could prove one of the most obvious and tangible impacts from the AI build-out beyond the contribution to real GDP that has occurred over the last 5 quarters. Recall that in Q1, the 2.1% real GDP gain included a contribution from non-residential fixed investment of 1.4%. So in the absence of the AI build-out, the conversation around the trajectory of the real economy would be much different.
So it really is all about AI.
Frankly, we'll take intelligence any way we can get it at this point.
I don't get it.
Neither do I. In the week ahead, the most important data print will be on Tuesday morning when investors receive June's CPI data. The consensus is for a 0.1% decline in headline CPI, while core is seen at 0.3%. Neither of the numbers, if they come in as expected, would add any urgency for monetary policymakers in either direction. Recall that much of the first half of this year was spent worried about elevated headline inflation potentially passing through to the core figures. Now, with the decline in energy prices leading to expectations for a negative headline inflation print, the conversation will eventually shift the other direction, i.e., will declining fuel costs translate into stable or lower core prices? The key uncertainty in this context is the lag between an increase or decrease in fuel prices and when that finally manifests in core CPI and PCE. Our operating assumption is that we're nearing the window where we might start to see evidence of higher fuel prices in the core goods and core services numbers. Now, that window is roughly 3 to 6 months after the initial energy shock. But this also implies that once we're through the summer months, assuming that we see further downside in fuel costs, then the market should be focused on evidence that core inflation has been contained or biased a bit lower. This is all the perfect setup for the Fed to remain on hold at both the July as well as the September FOMC meetings, barring, of course, any breakdown in the labor market or any external shock requiring a monetary policy response. The week ahead also contains Warsh's first semi-annual congressional testimony. This occurs on Tuesday at 10 a.m., following the CPI release. The timing all but guarantees that lawmakers will ask for Warsh's opinion about the CPI report and how that might or might not play in to the July FOMC rate decision. Warsh thus far has been very adamant in not offering the press or investors any clear forward guidance. It will be interesting to see the degree to which he can hold that stance in front of Congress. Now, clearly, he is only one of the voters on the committee, and so it would be reasonable for the chair to offer an assessment of the June CPI numbers from his perspective without translating that into any obvious action on the part of the committee as a whole. We'll also see the PPI numbers as well as import prices, which in practical terms means that by the end of the week, the market will have a good understanding of how core PCE performed in the month of June as well. Let us not forget that we get the June retail sales figures, which have consistently demonstrated a remarkable resilience on the part of consumers to further increase spending. We've been focused on the downside potential for spending, although to be fair, that has yet to materialize as the consumer continues to drive growth. And as a final note, on Friday at noon, we'll get the primary dealer meeting agenda, which includes a series of questions that have in the past informed the market about potential shifts in issuance as a precursor to the upcoming refunding statement. We continue to anticipate that Bessent will retain the several quarters language, which will, for all intents and purposes, simply push later the timeline for any potential increases in nominal coupon auction sizes. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. As a friendly reminder, the Extel Global Fixed Income Research Poll is now open. We would truly appreciate your support with 5 stars in our key categories of U.S. rates, technicals, fixed income, and short duration. For those who like to wait until the last minute, don't worry, there's still time as the poll closes on Friday, July 24th. Thank you for your help. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.